What if you had $50,000 today? Not in theory, not someday, right now. Would you save it or would you invest it? Most people believe those two choices lead to roughly the same future. They don't. In this video, I'm going to show you the real 20-year difference between saving $50,000 and investing that exact same $50,000 into simple ETFs. By the end of this video, you will clearly understand why one choice keeps you safe and the other one changes your entire financial future. In this video, you're going to learn what actually happens to saved money over long periods of time, what happens to invested money using simple ETF returns, how inflation silently changes the outcome, and how beginners can set this up inside a Fidelity account without complexity. Almost everyone grows up being told the same message: save your money, be responsible, don't take risks. But no one explains what saving actually does over long periods of time, and no one explains what investing quietly replaces. Let's create two people. Both start with $50,000 today. Same age, same income, same financial situation. The only difference is what they do with that money. Person A saves the $50,000. Person B invests the $50,000 into broad market ETFs. Let's start with person A. They put the $50,000 into a high-yield savings account. Let's assume a reasonable savings return. After 20 years, they still have roughly $50,000, maybe a little more. But here is what changed. Inflation reduced what that money can buy. Their number stayed the same. Their purchasing power did not. Saving feels safe because the number does not go down. But the real risk is not seeing red numbers. The real risk is quietly falling behind the cost of life. Now let's look at person B. They invest the same $50,000 into a simple broad market ETF portfolio. No stock picking, no trading, just long-term market participation. Let's assume a normal long-term return of about 10%. After 20 years, that $50,000 becomes roughly $335,000. Same money, same starting point, completely different future. This gap feels unbelievable to most beginners because it is not created by effort, it is created by time. The market compounds quietly while you live your life. This comparison becomes even more emotional when you realize something. Neither person added a single dollar after the beginning. No extra contributions, no raises, no extra savings, just one decision. Now let's make it more realistic. What if both people also invest $500 per month going forward? Person A keeps saving it. Person B invests it into ETFs. After 20 years, the investor is hundreds of thousands of dollars ahead. Not because they worked harder, because their money worked. Most people believe saving and investing are just two versions of the same thing. They are not. Saving is protection. Investing is multiplication. They serve completely different purposes. Saving is extremely important. Your emergency fund belongs in savings. Your short-term money belongs in savings. Your safety net belongs in savings. But your future does not belong in savings. Investing feels scarier because the numbers move. The balance goes up. The balance goes down. But volatility is not loss. It is movement. And movement is the price you pay for growth. ETFs allow beginners to invest without betting on individual companies. You are buying the entire market. You are not predicting winners. You are participating in long-term growth. Being too safe with money has a cost. It is the cost of missed opportunity. It is the cost of delayed freedom. It is the cost of fewer options later. If inflation averages only 3% per year, your $50,000 loses almost half its buying power over 20 years. That means your saved money quietly shrinks, even though the number never drops. This is not about luxury. This is about leverage. This is about giving your future self choices, better work options, less stress, more flexibility. Inside your Fidelity brokerage account, you choose a broad US market ETF. You optionally add a second ETF for diversification. You invest the money. You automate future contributions. You stop trying to improve the strategy. You allow time to work. You do not need $50,000 for this to matter. The behavior scales. The difference between saving and investing exists at $500. It exists at $5,000. It exists at every level. The most dangerous belief is thinking you can save your way into financial freedom. You can't. You can only save your way into stability. Wealth requires growth. This comparison is not about money. It is about direction. Saving keeps you where you are. Investing moves you forward. If you are building your future right now, your savings protect you, but your investments create you. And the difference between $50,000 saved and $50,000 invested is not just a bigger number, it is a completely different life curve.